Hi class, today we're going to be looking at chapter 17, problem 17b. And what we're going to be doing is we're going to be analyzing our our liquidity. And we do that by showing how the company has been able to convert their assets into cash. That's what liquidity means basically. And with liquidity, what we're going to be doing is we're going to be analyzing the company's ability to pay back short-term debts. So your creditors would be very interested in knowing whether or not your company would be able to pay them back. So we're going to use some liquidity measures to help us to determine that. The first liquidity measures that we're going to be looking at are what we call current position analysis, which means we're going to be learning how to calculate liquidity measures based on working capital, based on the current ratio, and also the quick ratio. So that's what we're going to be doing today. And so I'm going to share my screen with you now. And so you should be able to see chapter 17, problem 3b. We're going to be looking at the effect of transactions on current position analysis. The data is pertaining to the current position of the LaCroix Industries, and the assets are presented as follows. We have cash in the amount of $800,000, marketable securities for $550,000, accounts and notes receivable. The net amount is $850,000. The net amount is referring to, this is the amount after we've considered the allowance for doubtful accounts. This is what we think that we're going to be able to receive from accounts receivable and notes receivables. Our inventories are $700,000, prepaid expenses $300,000, accounts payable, which is your current liability, of $1,200,000, and then notes payable short term is our current liability amount of $700,000, as well as accrued expenses. Your accrued expenses are your liabilities that result from your accrual adjusting entries, and these are going to be current. So all of these are examples of current assets for LaCroix Industries. The first thing they want you to do is to compute the working capital. Before we can do that, we need to total up our current assets. So as I've done is I've taken our current assets of cash, marketable securities, accounts receivable and notes receivable net, prepaid expenses, our inventories and our prepaid expenses. All of those are added together to get a total amount of $3,200,000. That's our total current assets. When you're working with working capital, you need to determine your current assets first and then determine your current liabilities. The current liabilities were given to us at the amount of accounts payable, $1,200,000 is a current liability. Our notes payable that are short-term are also current liabilities, and our accrued expenses, such as salary payable, interest payable, those things are added together to get the accrued expenses. Combine all three of these amounts to get your total current liabilities. To find your working capital, you simply use this formula here. Take your total current assets and subtract your total current liabilities from it. That will give you the working capital. So our current assets were $3,200,000 less our current liabilities of $2 million. That means that we have this amount of current assets that are available to cover our current liabilities. The amount is $1,200,000 for working capital. When you are when you are analyzing the current ratio, we're going to do basically the same thing as we did before. We've got to figure out what the total of our current assets are and the total of our current liabilities. And then you simply divide the current assets by the current liabilities, and that will give you your current ratio. So in this particular example, we took $3,200,000 and we divided that by our current liabilities of $2 million, and that will give you 1.6 as the amount of the current ratio. The current ratio is a more reliable indicator of the company's ability to pay the current liabilities than is the working capital. So the current ratio is preferred by our creditors over what the working capital is. They can get a better idea of what's actually happened and how well this company would be able to pay back their short-term debts. In Part C, they want you to calculate what is called the quick ratio. The quick ratio is basically all of your current assets with the exception of inventories and prepaid assets. So things like cash, marketable securities, your accounts receivable, and your notes receivable net amount. These are called quick assets. We're going to add those together. The total of our quick assets is $2,200,000. And to find the quick ratio, what we will do is we'll take our quick assets and divide those by our current liabilities. That will give us a quick ratio of 1.1%. That's our quick ratio for this company. And so the quick ratio actually helps to the creditors to know what their debt paying ability is of this company. And it's really a better measure than is your current ratio. So if you can figure out what the quick assets are, and they're all your current assets with the exception of inventories and prepaid assets, total those up, then divide it by your current liabilities, that will give you your quick ratio, which in this example was 1.1. So in Part 2, we're also going to be computing the working capital, the current ratio, and the quick ratio, but we're going to do it after each of the following transactions that they give us. And so what I decided to do was to state the transaction itself, prepare the journal entry so you could see what's happening with your accounts. And then you can analyze those based on what happened in that transaction. So in Part A, they're telling you that you've sold marketable securities at no gain or loss. Because there was no gain or loss, you just sold the marketable securities for what they cost you. And the cash would be debited in that case for the amount of $500,000, which is what you sold the marketable securities for. Your marketable securities, which is a current asset, will go down by $500,000. This is your journal entry that they did not ask you to record, but for you to understand what's happening with the working capital and the current ratio, you have to understand what happened in this journal entry. So transactions A effect on the current assets. The current assets before the transaction were this. These were the given amounts that they gave to you. But with transaction A, our cash account increased by $500,000. So our new balance in the cash account, after you have posted this journal entry, would be $1,300,000 in the cash account. because your marketable securities are going down, we're going to deduct that from the balance before we sold those marketable securities. And what we have left over is a balance of 50,000. And what that will do is that will affect our current assets. So let me enlarge the column so you can see the amount of the current assets. It affected the current assets. It didn't affect them at all because there was an exchange of one asset for another. In other words, our cash went down, went up, excuse me, and our marketable securities went down. This is a wash type of transaction. So our current assets were not affected in total. So it'd be the very same thing as what we got as an answer before. Our working capital, our current assets are 3,200,000. We would back out our current liabilities, which did not change. The current liability amount would be 2 million. So we would subtract 2 million from 3,200,000, and that will give us the same amount for working capital as we had a while ago, which is 1,200,000. Our current ratio would also not change because our current assets didn't change. It wouldn't have affected our working capital. It wouldn't have affected the current ratio or the quick ratio because the amount of the current assets didn't change. And your quick assets, which would have been cash and marketable securities, the cash amount changed and the marketable securities changed, but the total amount would not have been affected with the amount of the quick assets. So it would stay the same also at 1.1%. In the B part of this transaction, they told you that you paid accounts payable. Well, this time your accounts payable would have decreased, which means that your current liabilities would decrease. Your cash amount is decreasing, so your current assets would have decreased. So the current asset amount would have changed after this transaction. This is what it was before, but because our cash went down, our total current assets would have changed to 2,912,500. In the same transaction, because our liabilities decreased, it would have decreased our current liabilities. Our accounts payable went down, so the balance in the accounts payable account would have gone down, which would have affected your total liabilities. Take your current assets and subtract your current liabilities, and that will give you a working capital amount of 1,200,000. Your formula for working capital is current assets less current liabilities. So your current assets less your current liabilities meant that your working capital was 1,200,000. Your current ratio would have changed because your current assets are now 2,912,500. You'll simply divide the 2,912,500 by your current assets of 1,712,500, and that would give you the new current ratio amount. And then what you would have to do is analyze your quick assets. Your quick assets would have been the sum of your current assets, which were, if we go back up to the top of the page, the current assets were 800,000 in cash. We had some marketable securities and we had some accounts and notes net. You do not include your inventories or your prepaid amounts. So your quick assets were 2,200,000. And so to find your quick ratio, we would take that 2,200,000 because it wouldn't have changed from this. And that would have given you the new quick ratio. So your quick ratio is your quick assets, which are all your current assets with the exception of inventories and prepaid expenses. Add those up, add your current liabilities up, and divide the two to get your quick ratios. So again, you can see here that I've got a formula for that. And what I did is transactions B effect on current assets. Your current assets went down here. So the sum of D79, D80, and D81 added together would give you the total of your current, the total of your quick assets. And then you would divide it by your current assets. And that would give you the amount for the quick ratio. I think I said that right, but again, your formulas are right here. It's quick assets divided by your current liabilities gives you the quick ratio. And all you're doing is you're analyzing what happens to your current assets and your current liabilities, or in this case, your quick assets and your current liabilities, to see what the changes are going to be for this particular company. And so in D, they paid off their notes payable of $125,000. Since your notes payable was considered to be short-term, our current liabilities would decrease by $125,000, and your cash would also decrease by $125,000. And so you would analyze that on what happened to the current assets and your current liabilities. And this is what happened after you had paid off that particular debt. You would have had current assets that total $3,075,000. Your current liabilities would now total $1,875,000. To find the working capital, we would subtract $1,875,000 from the $3,075,000, and that would give you your working capital. To find the current ratio, we would take our current assets and divide those by the current liability amounts, and that would give us 1.6. And then our quick ratio, you would have to determine if that would have affected your quick assets, which it would not, because there was no decrease in inventories and there was no decrease in prepaid expenses. There was no change, in other words, in inventories and prepaid expenses. So you'd use the same quick assets as you did before and divide it by your new current liabilities to get 1.1%. When you declare a cash dividend, what that does is it reduces the account called retained earnings. It also increases an account called dividends payable, and dividends payable is a current liability. So your retained earnings would have gone down and your dividends payable account would have gone up. So the current assets were not affected at all, but it would have affected your current liabilities by increasing the current liabilities for the new account called dividends payable. So we added a new account in here at dividends payable. When you combine all these together, your new total current liabilities is $2,325,000. So to find your working capital, we would take our current assets, subtract our current liabilities from them, and that gives you the working capital. We would also take our current assets and divide them by our current liabilities to get our current ratio. And your quick ratio ends up being 0.9 this time. So what you would do is sum up D cell addresses D152 through 154, and then you would divide it by D164, the current liabilities, which would give you this 0.9%. So again, when you're figuring your quick ratio, you have to know what your quick assets are. Your quick assets are all of your current assets with the exception of inventories and prepaid expenses. Since inventories and prepaid expenses were not affected in this transaction, then we would use the quick assets that we have been using from the past transactions and divide it by the current liabilities. On the next transaction, we declared a common stock dividend on common stock at $150,000. Our journal entry would have reduced retained earnings and credited an account called common stock dividend distributable. That account is neither a asset accounts weren't affected, no current assets were affected, no current liabilities were affected there. So basically you take your total of your current assets, the total of your current liabilities. To find working capital, you subtract. To find the current ratio, you take your current assets and divide it by your current liabilities to get this amount. And then your quick ratio would be your quick assets added together, which would have been your cash, your marketable securities, your accounts receivable and notes receivable net amount. Those three amounts added together would give you your quick assets. Divide those by the total of the current liabilities, and that would give you the 1.1%. In Part G, they borrowed cash from a bank on a long-term note this time. So cash would be affected and your long-term liabilities would be affected. This note payable is not considered short-term, so your current liabilities would be unaffected. Your current assets, however, would be affected because cash has increased the cash amount. So the current assets in total increased to $4,200,000. Your current liabilities did not change. To find working capital, we still subtract our current assets from our current liabilities. And that will give you, in this case, $2,200,000. Our current assets divided by our current liabilities would give you a current ratio of 2.1. And our quick ratio would be the same quick assets, cash, accounts receivable, notes receivable, marketable securities, add those together, and then divide it by your current liabilities. It gives you a quick asset, a quick ratio of 1.6. In H, you receive cash on account. So your cash went up and your accounts receivable went down. So that means there was a wash in the current asset section because one asset was exchanged for another. The current liabilities were unaffected. So your total current assets less your total current liabilities will give you the amount of your working capital. Your total current assets divided by your total current liabilities gives you the current ratio. And then your quick ratio would not have changed because, well, I guess it would have changed because your total of your quick assets would have changed. Your cash increased, but your accounts receivable went down. So no, it didn't change either. So that would have been left there. And then in I, it says you issued additional shares of stock for cash at $2 million. You would have debited your cash for $2 million and you would have credited your common stock for the par value of that common stock. They didn't tell us what that was in this example, so I'm leaving this as a question mark here. We really can't figure out what that is. And we don't know what the paid-in capital would be either, because they didn't give us the par value of the shares of stock. But we do know in this transaction that cash has increased. So it would have affected your total current assets. Because cash is increasing, the total current assets will increase to $5,200,000. Your liabilities, current liabilities stayed the same. Current assets less your current liabilities would give you the working capital at $3,200,000. Your current ratio would be current assets divided by current liabilities, which is 2.6%. And then your quick assets would have changed because your cash account increased. It would also increase your quick assets. So your quick ratio is now going to be 2.1%. In the next journal entry, we paid cash for our prepaid expenses. Again, we exchanged one asset for another asset. And so the total of our current assets would not change. But the amounts would change for your quick assets in this case. But your total current assets don't change, because it's an exchange of one asset for another, one current asset for another current asset. Your current liabilities wouldn't change. Your working capital is still going to be $1,200,000. Your quick ratio is still going to be 1.6, which is your total current assets divided by your total current liabilities. That would give you your current ratio. And then your quick ratio would have changed because your cash amount decreased. It decreased to $600,000. So cash of $600,000 plus marketable securities plus your accounts and notes receivable added together would give you the total quick assets. And then you would divide that by your current liabilities, and that would give you a quick ratio of 1. So basically, this problem was just having you calculate your current ratio, your working capital, and your quick ratio using different situations for the different transactions. These are all examples. The working capital, the current ratio, and the quick ratio are all examples of how we assess the liquidity of the company. And again, the liquidity of the company is how, whether or not our company would be able to pay back their current liabilities. So banks would be interested in knowing what happens with our current assets and our current liabilities to be able to assess whether or not they should loan you some money. And it would give your company an idea of how well they can pay back their current assets, or excuse me, how well they can pay back their current debt, which is your short-term debt. And so that's all I want to talk to you about today. We'll see you again next time. I'll stop sharing this with you, and I'll see you later. Bye-bye.